Senior executives will meet to assess an organization's past performance and set objectives and strategic direction for the coming year in light of the current economic climate. Depending on the organization and type of business, the following items should be considered. A. Analysis of past performance. What went right? What went wrong? Variance analysis. Assessment of effectiveness of current year's budget and changes required to be reflected in new budget. B. Market. Geographical area served. Size of market. Rate of growth, if any. Behavior of prices. Inflation, deflation, price wars. Future opportunities to gain market share. Potential horizontal and or vertical acquisitions. C. Competition. Existing and potential competition for market share. Recent development affecting participation by competition. Defensive strategies required, if any. Behavior of prices. Inflation, deflation, price wars. D. Competitive position. Analyze each competitor's market share and marketing strategy. Review competitors and own organization strength and weaknesses. Industry trends. E. Technology. New developments, trends, and opportunities. Use of technology to reduce costs. Flowing from the above considerations, attainable goals and objectives will be established for the coming fiscal budget year. Budget meetings will be held with the appropriate department and organization heads. Depending on the organization, these individuals will have varying degrees of input into the final plan. It is commonly held that the more input lower-level managers have into the budget process, the more they're likely to buy into it, and for the organization to meet the agreed budget targets. As well, lower-level managers have more specific knowledge concerning their areas of operations and can provide valuable input with respect to the numerous estimates that must be made concerning current and capital costs and revenues. However, targets should be attainable and fair so as not to blunt motivation among the individuals involved. However, senior management must be vigilant to ensure that the agreed targets and the budget amounts are reasonable rather than being too easy to meet or attain. Budget revenues should not be understated and expenses overstated. In other words, the budget should not contain padding. Further, where an organization head's performance evaluation is based on a return on net assets employed calculation, the budget amounts comprising those net assets must be fairly stated as well. Net assets employed means the total assets less the total liability used in generating the corporate entity net earnings. In other words, a manager's performance evaluation is based not only on the earnings, but also on the corporate resources used to generate those earnings. Managers attempting to pad budget will try to understate budgeted net earnings and overstate budgeted net assets employed. The actual preparation of the budget could involve numerous individuals in the departments. Each department manager will be responsible for their department's budget and will delegate the various preparation tasks as they see fit. However, of uppermost importance and significance is the sales budget, which will be prepared by the sales department. The level of sales will have a direct impact on the choices available to the organization and its various departments. The level of sales will not only impact the manner in which expenses are budgeted, but also influence the capital budget. In challenging economic times, organizations will attempt to trim expenses and limit capital projects. Arriving at different budget amounts is a very analytical process. For instance, when arriving at a dollar number for sales in the sales department, we'll consider expected sales to existing and new customers, sales resulting from new investments, products, and services, the effect of discontinued products and/or services, and any expected lost customers or other sources of revenue. Inflation and deflation rates would also be factored into the final budget sales amount. Each expense must be examined in various levels of detail to determine an appropriate amount. For example, to complete amount for salaries and wages for the budget year, the full year effect of increases and decreases in personnel during the current year must be considered, along with planned hires and reductions in personnel for the budget year. Percentage increases with respect to salary and wage rates, along with benefit levels, will also need to be accounted for. As noted before, the budget process commences several months prior to the end of the fiscal year. Therefore, part of the budget preparation process involves forecasting actual results to the end of the year. The time and skill required to do this will to some extent depend on the nature of the operations. As the fiscal year draws to a close, the last month or period's actual results become available, and this will give the budget preparer an increasingly accurate picture of how the fiscal year will look. This additional information will ultimately be reflected in the final approved budget. Business analysts frequently issue earnings forecasts during the year with respect to companies they are covering. Forecast and projection are essentially synonyms in the context of estimating actual results in relation to budget preparation. The use of spreadsheet software, such as Microsoft Excel, facilitates the budget process and budget preparation. Multiple sensitivity analysis and what-if scenarios can be prepared easily to determine the financial impact under different plans and assumptions. Although perhaps obvious, diligence is always required to ensure that the final budget does in fact consist of the final agreed versions of different components. Each department's budget must be approved by the appropriate senior manager or executive. Often, this part of the process will involve amendments to individual plans before final approvals are granted. These may be requested changes or changes flowing from updated financial data as the fiscal year draws to a close. Ideally, all budgets should be approved prior to the end of the fiscal year to facilitate first period reporting in the budget year. In large organizations, divisional heads are approving their department's budgets, and the senior corporate executives are approving the overall divisional budgets. A memo supporting the individual budgets and numbers and the request for approval will be prepared by appropriate individuals at different levels within an organization. For example, department heads submitting budgets to a division head for approval would each include a budget memo supporting their individual budgets. The division head would then prepare their own memo to accompany their division's budget submission to, for instance, the company's corporate head office. As the individual budgets are prepared, a consolidated budget is also being prepared. This master budget is periodically amended to reflect any changes to the individual plans. The final budget will reflect all the approved individual plans data and will serve as the document that the organization's chief executive office approves. Generally, individual budgets are approved on the basis of fiscal year end numbers rather than on a monthly basis. As such, the last step after budget is approved is to provide the accounting department with a monthly breakdown of the approved annual amounts. In this way, actual month results may be compared to budget with any variances followed up and the corrective action taken. Essentially, these amounts then become monthly budgets. Although not strictly part of the budget process, actual results must be compared to amounts budgeted. Explanations must be obtained for material positive and negative variances. Senior management will require a memo explaining the reasons for the period variances together with recommendations for corrective action.